Imagine waking up tomorrow. The stock market is crashing, banks are limiting withdrawals, and prices are going crazy. The real question is, will your savings survive? Because during economic turmoil, it's not the rich who panic, it's the unprepared. Let's talk about how you can shield your savings like a smart investor, not a scared one. First, let's be clear on what we mean by economic turmoil. This isn't just a bad day on Wall Street. We're talking about major events like recessions, severe market crashes, runaway high inflation, banking crises, and widespread job losses. History gives us some stark examples. During the 2008 financial crisis, markets plunged over 50%. In the 2020 pandemic crash, the market fell 30% in just a few weeks. And during periods of high inflation, your hard-earned money just loses its buying power day after day. The people who navigated these storms best weren't just lucky, they were prepared. And that's exactly what we're going to make you today. Step 1 is to build a shock-proof emergency fund. Think of this as your financial first aid kit. If chaos hits and your income suddenly stops, you need a cash buffer to cover your essential needs without having to sell your investments at the worst possible time. The golden rule here is to have 6 to 12 months of your living expenses saved up. So if your monthly expenses are around $2,000, your emergency fund goal should be between $12,000 and $24,000. Where should you keep this money? In a high-yield savings account or another safe, liquid account where you can access it immediately. This is crucial. This money is not for investing. It's not for chasing trends. This is your survival money, pure and simple. Step 2 is to never keep all your money in one place. One of the biggest mistakes people make is thinking, all my savings are in my bank account, so I'm safe. That's putting all your eggs in one basket. The smart move is to diversify. A well-balanced strategy might look something like this. Maybe 40% of your assets are in cash and high-yield savings for liquidity, 30% in broad market index funds for long-term growth, 20% in bonds or other safer assets for stability, and maybe 10% in gold or alternative assets as a hedge against uncertainty. The logic is simple. If one asset class takes a hit, the others can help balance it out, preventing a catastrophic loss. Step 3, and this is a big one, is to understand inflation, the silent killer of savings. If inflation is running at 6% and your savings account is only earning you 1%, you are losing 5% of your purchasing power every single year without even noticing. Let's put that into perspective. $10,000 today with 6% annual inflation would only have the buying power of about $5,500 in 10 years. That's nearly half its value. Gone. Scary, right? This is precisely why just saving isn't enough. You have to invest to make your money grow faster than it's being devalued. This brings us to step 4. Own strong assets that survive crashes. Not all assets are created equal, especially during the downturn. Historically, certain assets have proven their resilience over the long term. These include broad stock market index funds, which represent a wide slice of the economy, real estate, which provides tangible value, gold, which often shines during times of uncertainty, and government bonds, which are considered among the safest investments. Think about the 2008 crash. It was brutal, but the markets eventually recovered and went on to reach new highs. The key takeaway is that crashes are temporary, but decisions made in a panic, like selling everything at the bottom, can cause permanent damage to your wealth. Step 5 is to kill your high-interest debt. During economic turmoil, debt becomes a massive anchor weighing you down. Credit card interest rates can be over 20%. If you are paying 20% interest on a credit card, there is no investment in the world that can safely and consistently beat that return. Your first line of defense in preparing for a crisis is to eliminate this kind of toxic debt. Paying it off is like giving yourself a guaranteed risk-free return on your money. Freeing up that cash flow also strengthens your financial position immensely, making you far more resilient. Next, step 6 is about creating multiple income streams. This is your financial armor. If you rely on a single paycheck, you're vulnerable. If that one income stream stops, you're in trouble. But if you have another one or several, you can keep going. What do these look like? It could be anything from freelancing in your field, starting an online side hustle, earning dividend income from your stock portfolio, or collecting rental income from a property. In a crisis, income security is often more important than investment returns. Having money coming in from different sources is one of the most powerful forms of financial protection you can have. Now for what might be the most important step of all. Step 7. Control your emotions. This is where most people fail. During market crashes, the news is filled with fear and panic. The natural human instinct is to sell everything to stop the losses. But this is almost always the worst thing you can do, as you're selling at the very bottom. Smart, disciplined investors do the opposite. They stay calm, they stick to their long-term plan, and they often see the panic as an opportunity to buy quality assets at a deep discount. When a fundamentally strong company's stock drops 30% simply due to widespread fear, a long-term investor sees a sale. A short-term trader only sees the red numbers and runs. Your mindset is your greatest asset. Step 8 is to tailor your asset allocation to your age. Your protection strategy isn't one size fits all. It heavily depends on your timeline. If you're in your 20s or 30s, you have decades before retirement, so you can afford to take on more risk for higher potential growth. Your portfolio might be more heavily weighted towards stocks. If you're in your 40s or 50s, you're likely looking for a more balanced strategy, blending growth with capital preservation. And if you're in your 60s or older, your focus shifts primarily to stability, income generation, and protecting what you've built. A younger investor can ride out a crash, but someone nearing retirement needs more stability. Let's walk through a real example scenario to see how this all comes together. Imagine you have $50,000 in savings. The bad strategy would be to go all in on a hot trend, like putting everything into crypto during a bull run. When the inevitable crash happens, your portfolio plummets to $20,000. You panic. You've lost more than half your savings. Now, let's look at the smart strategy. From that same $50,000, you allocate $20,000 to your emergency fund in a high-yield savings account. You invest $15,000 in diversified index funds, put $10,000 in bonds for stability, and $5,000 in gold as a hedge. The same market crash happens. Your index funds drop, but your bonds and gold hold up better. Your total portfolio might drop to, say, $42,000. It's a drop, yes, but it's stable, it's recoverable, and it's manageable. You have your emergency fund untouched, and you haven't been forced into a panic sale. That's a huge difference, and it's a difference between financial ruin and financial resilience. So let's recap the real Shield formula. It's not a secret, and it's not complex. It's having a fully funded emergency fund. It's diversification across different asset classes. It's having low or zero high-interest debt. It's maintaining a long-term mindset. And it's exercising emotional discipline when everyone else is losing their minds. Together, these elements form your financial armor. At the end of the day, remember this: you can't control the economy. You can't control what the markets will do tomorrow. But you can absolutely control how prepared you are. Thanks for watching. If you found this guide helpful, make sure to like, subscribe, and hit that notification bell so you don't miss our next video on building real, lasting wealth. See you next time.